China buys gold. America buys Bitcoin. But they are not playing the same game. China is building a defensive shield against dollar credit risk. America is trying to absorb crypto into a dollar-centric digital financial system. The real prize isn't gold or Bitcoin. China's central bank has been buying gold for 21 consecutive months, reaching about 2,366 tons by July 2026, roughly 8% of its foreign exchange reserves. This is not a speculative bet. It's a balance sheet defense. Gold has no issuer, no counterparty risk. Unlike U.S. Treasuries, which are liabilities of the U.S. government, gold is nobody's debt. When geopolitical risk rises, central banks want assets that don't depend on another country's credit. China is reducing its exposure to U.S. government debt, which fell to about $633 billion in June 2026, down 13% year-over-year. But this isn't de-dollarization. It's a hedge within the existing system. By holding gold, China ensures that even if the U.S. dollar system faces disruptions, its reserves retain value. This is a prudent move for a major economy that wants to protect itself from potential financial sanctions or a decline in the dollar's purchasing power. The core logic of gold as a reserve asset is simple: it has no counterparty. When you hold a U.S. Treasury, you hold a claim on the U.S. government. When you hold a bank deposit, you hold a claim on the bank. Gold is a claim on nothing. It's a physical asset with intrinsic value. This makes it a unique hedge against systemic credit risk. For central banks, the value isn't in yield, it's in the absence of default risk. In times of crisis, when the creditworthiness of governments and financial institutions is questioned, gold retains its value because it doesn't rely on any promise to pay. This is why central banks, especially those with large dollar holdings, diversify into gold. It provides a stable foundation for their balance sheets, reducing the risk that a default or devaluation of a major currency will erode their wealth. America's approach is fundamentally different. It's not just buying Bitcoin, it's building a system. The 2024 approval of spot Bitcoin ETFs was a turning point. It allowed institutional investors to gain Bitcoin exposure through traditional financial channels. Then, in March 2025, the U.S. established a strategic Bitcoin reserve, using Bitcoin seized in criminal and civil cases, with a policy of not selling. This is symbolic. The U.S. government now holds Bitcoin as a reserve asset. But the real game changer is stablecoins. The Genius Act of 2025 created a federal framework for payment stablecoins, requiring them to be backed by high-quality dollar assets like U.S. Treasuries. This is the key to a new digital dollar cycle. By integrating Bitcoin and stablecoins into the regulated financial system, America aims to extend the dollar's reach into the crypto economy, ensuring that digital transactions still occur in dollars. The Stablecoin-Treasury Loop is the engine of America's digital dollar strategy. Here's how it works: global users buy stablecoins like USDT or USDC. The issuer receives dollars. To back the stablecoin, the issuer buys U.S. Treasuries. The Treasury gets new demand. The stablecoin circulates in the global blockchain economy. This creates a new demand channel for U.S. debt, directly from the crypto world. It's a virtuous cycle that could expand the dollar's reach without traditional banking. For example, a business in Argentina can use USDT for international trade, effectively using dollars without needing a U.S. bank account. The demand for stablecoins thus translates into demand for U.S. Treasuries, as issuers must hold reserves. This loop not only supports the dollar but also provides a stable foundation for the crypto market, as stablecoins are pegged to the dollar. China and America are pursuing opposite strategies. China is defensive, reducing exposure to U.S. credit, adding gold, and promoting yuan internationalization. America is offensive, absorbing crypto into the dollar system, using stablecoins to extend the dollar's reach, and tokenizing U.S. debt. One is about reducing dependence on an existing network. The other is about expanding that network into new territories. These are not competing bets on gold versus Bitcoin. They are competing visions for the future of global finance. China's approach is to build resilience against potential disruptions in the dollar system, while America's approach is to ensure that the dollar remains the central currency in the digital economy. The success of either strategy will depend on how the global financial landscape evolves, including factors like regulatory changes, technological innovation, and geopolitical shifts. The traditional dollar cycle works like this. America imports goods, dollars flow abroad, foreign holders invest in U.S. treasuries, and the U.S. government spends. The digital dollar cycle is different. Global users buy stablecoins, issuers buy U.S. treasuries, and the stablecoins circulate in the blockchain economy. This means dollars can reach individuals without a U.S. bank account. A user in Africa, Latin America, or Southeast Asia can hold USDT on their phone. They are effectively holding dollar purchasing power. This is a major upgrade to the dollar's distribution network, bypassing traditional banking and SWIFT. For instance, a freelancer in Nigeria can receive payments in USDC, avoiding the high fees and delays of traditional remittance services. This expands the dollar's influence to billions of unbanked or underbanked individuals, making the dollar the de facto currency of the internet. The digital dollar cycle can be expressed as a flow: users buy stablecoins, issuers invest in treasuries, the treasury gets funding, and the stablecoins are used in global transactions. This is a new channel for dollar expansion, independent of traditional banking. It's a way to make the dollar the native currency of the internet. This cycle is self-reinforcing. As more people use stablecoins, more treasuries are purchased, which increases demand for dollars and supports the U.S. economy. It also provides a stable foundation for the crypto market, as stablecoins are pegged to the dollar. The cycle is not without risks, such as the potential for runs on stablecoins if confidence is lost, but it represents a significant innovation in how currencies are distributed and used globally. Bitcoin is not trying to replace the dollar. In America's design, it plays a different role: digital gold. It provides scarcity and a non-sovereign store of value. Stablecoins are digital cash. U.S. treasuries are the underlying reserve. America's capital markets financialize all of it. This creates a three-layer structure: Bitcoin for scarcity, stablecoins for transactions, and treasuries for reserves. They are complementary, not competitive. Bitcoin's success doesn't mean the dollar's failure. In fact, as Bitcoin is used as collateral for dollar loans, it could strengthen the dollar system. For example, a crypto investor can borrow dollars against their Bitcoin holdings, increasing the demand for dollars. This integration allows Bitcoin to serve as a new asset class within the dollar-based financial system, rather than a threat to it. There's a paradox: the more Bitcoin is integrated into the dollar system, the less it is an outside asset. ETFs, custody, derivatives, and institutional adoption all tie Bitcoin to the dollar. Its price is quoted in dollars, its futures are settled in dollars, and its NAV is calculated in dollars. This doesn't mean Bitcoin loses its decentralized nature. But it does mean its financial center of gravity shifts. The question is whether Bitcoin can remain a true hedge if it becomes deeply entangled with the system it was meant to bypass. For instance, if a major bank holds Bitcoin as collateral and faces a liquidity crisis, it might sell Bitcoin, causing its price to drop, which could undermine its role as a safe haven. This paradox is central to understanding Bitcoin's evolving role in the global financial system. Gold has thousands of years of monetary history. Central banks hold it, banks accept it as collateral, and there are mature lending and derivatives markets. Bitcoin's financial history is only about a decade and a half. In a liquidity crisis, gold behaves like a safe haven, while Bitcoin often drops with tech stocks. This doesn't mean Bitcoin is a failure. It means its monetary evolution is incomplete. It's still transitioning from a speculative asset to a macro asset, and potentially to a reserve asset. The process is ongoing. For example, during the COVID-19 market crash in March 2020, gold initially fell but quickly recovered, while Bitcoin also fell but took longer to recover. This shows that Bitcoin is still correlated with risk assets, whereas gold has a longer track record of being a store of value in times of stress. The real story isn't whether Bitcoin hits $200,000. It's about 5 structural questions. First, can Bitcoin become a widely accepted collateral asset? Second, can stablecoins become the largest dollar distribution network? Third, can U.S. treasuries be tokenized at scale? Fourth, Can on-chain capital markets replace parts of traditional banking? Fifth, will global investors hold dollars without needing a US bank account? If these trends continue, crypto will not just change an asset class. It will change the technical architecture of the dollar system. For instance, if tokenized treasuries become common, they could be used as collateral in decentralized finance, creating new efficiencies. These questions are not about price speculation but about the fundamental infrastructure of global finance. The phrase, "China buys gold, America buys Bitcoin," is catchy, but it misses the point. China is adding assets that don't depend on US credit. America is trying to make the next digital financial system dollar-centric. Gold represents the ability to exit the credit network. Bitcoin represents a new non-sovereign scarce asset. Stablecoins represent the interface for the dollar in the blockchain world. The real competition is between two visions, one that seeks to reduce dependence on the existing system, and one that seeks to expand that system's reach. Which vision wins will shape global finance for decades. We'll be back with more deep dives into the forces shaping markets. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.